In both the world of DeFi and just regular Fi, the weekend chatter was dominated by rumors that two of the biggest investment banks in the world, Credit Suisse and Deutsche Bank, are dangerously close to going under. But are they really? Is this the Lehman Brothers 2.0, or are we getting ahead of ourselves?
Also, would DeFi fare any different under similar circumstances? To answer that, first, let's step back to understand what's going on. Credit Suisse has been losing money for 3 straight quarters and missing analyst expectations at a time when the rest of the Wall Street has been posting profits. And that's been due to a string of bad bets which have cost the bank huge amounts of money. The most notorious one is probably the $5.5 billion hit it took lending to Archegos Capital Management, a failed family office. It was also forced to freeze billions after financial services firm Greensill Capital, to which it had lended money, folded. The losses and missteps have been dragging the stock down all year, but things really started to unravel over the past week after reports by financial news media and Wall Street analysts that Credit Suisse faced a capital gap of about 4 billion Swiss francs, and it was looking for investors to raise fresh cash amid a radical overhaul of its businesses.
I think we could all happily say Auf Wiedersehen to Deutsche Bank and Credit Suisse, considering they have a track history between the two of them that includes espionage, drug money laundering, wire fraud, tax fraud, exchange rate manipulation, funding of the Keystone Pipeline, and close business ties with Russian oligarchs Donald Trump and Jeffrey Epstein. But wishing for their demise would be blatant disregard for the global economy, which would suffer big time. As Graham Stephan points out in this tweet, the Lehman Brothers held $600 billion in assets when they went under in 2008. At the moment, Deutsche Bank and Credit Suisse hold 4.6 times that amount, with $2,800 billion between the two of them. In other words, their collapse could lead to the 2008 crisis, but then on steroids. So for Credit Suisse, the rumors seem to be a self-fulfilling prophecy coming true after Credit Suisse CEO Ulrich Kuhner issued a memo on Friday saying that the bank was at a critical moment. Looking to calm investors, he wrote this, which essentially says, ignore the incoming press and our stock price performance, Credit Suisse will be fine. This did little to calm anyone, and a flood of negative attention came Credit Suisse's way, with the Twitter community pointing out that their stock has fallen by 40% in the past year.
And it wasn't just the stock which raised red flags across markets, but the bank's credit default swaps, or cost to protect against bank's default, has soared to a record high, higher than the 2008 crisis levels. The market action at Credit Suisse has also dragged down Deutsche Bank, which has had a similar string of bad bets and scandals. So what's different here versus DeFi is that in the case of these banks, we're left to rely on a CEO memo to tell us that Credit Suisse has solid capital and liquidity. And we only got a hold of that memo because it was leaked by reporters. He also told employees that he will be sending them a regular update until the firm announces the new strategic plan on October 27th. But you know what would be better than leaked memos, financial reports published only every 3 months, and statements from bank management? Real-time, transparent access to view the state of any financial entity at any time. That's what DeFi provides. If Credit Suisse were run on-chain, investors and the general public would have an exact idea of its balance sheet, capital ratios, and quality of its assets. And those risks would have been better priced over time and hopefully better managed with input from the wider community, rather than come as a shock over the weekend, riddled with speculation that's roiling the entire global markets. But we shouldn't be panicking just yet.
So, even though many of us are experiencing some sort of deja vu moment, we should be careful comparing the Lehman Brothers to 2008. Much has changed since then to make sure banks don't fall like the Lehman Bros did. For the EU, the 2008 crisis was a wake-up call and led to the establishment of a single resolution mechanism, or SRM, a central institution with the sole purpose of making sure that any institution that is failing or has failed will be restructured in such a way that the bank's failure does not cause harm to the broader economy or cause financial instability. In Switzerland, the Swiss National Bank plays a similar role as the SRM. So, for both Credit Suisse and Deutsche Bank, we can expect intervention before either could possibly go under. All in all, it looks like Credit Suisse may not be going down after all, although Justin here does make a point, tweeting, Credit Suisse's chairman's last name is Lehman. That's all the alpha you need to know about this situation. Despite all the rumors, both the prices of ETH and BTC remained within their weekly range as we entered October. Looking back on September, it was a mixed month overall.
So the financial system may be better protected than in 2008, and hopefully there won't be a similar global scale crash. But if there's one thing that this bear market is making clear, is that transparent markets that work programmatically with smart contracts have so far fared a lot better than both CeFi and TradFi.
This has been your Monday Quick Take. So long, and see you later.